A legislative proposal currently under consideration in Congress has the potential to deactivate 175 million credit card accounts across America, not temporarily suspend them or decrease their limits, but completely deactivate them. The individuals who would face account termination first are precisely those who depend on them most heavily. Retirees living on fixed retirement income, individuals managing healthcare related financial obligations, anyone whose credit rating falls beneath 740. This is not speculation about events that may occur many years into the future. The nation's chief executive has openly supported this proposal. The legislation enjoys support from both major political parties in the Senate and House of Representatives. Furthermore, the financial services sector has formally informed congressional representatives exactly how they would respond if this becomes law. They would terminate accounts, not thousands or millions, but 175 million. This presentation will examine precisely what is occurring, the reason the mathematics underlying this situation makes widespread account terminations unavoidable, how an account termination impacts your credit rating and overall financial well-being, how a companion legislative proposal advancing through Congress simultaneously would affect your rewards benefits, and 5 concrete actions you should implement immediately to safeguard yourself before any provisions take effect. For anyone carrying a credit card currently, the following 20 minutes may prevent a financial crisis you never anticipated. Let me begin with the actual events, because most individuals have only encountered the summary headline. The headline appears to convey positive information. On a recent date, a proposal emerged calling on Congress to establish a credit card interest rate ceiling at 10% for 1 year. It was presented as assistance for hardworking citizens who are overwhelmed by credit card obligations. On the surface, this appears to be the most beneficial financial development in years. Here is the reasoning. The current average credit card interest rate across America stands at 28.7%. Certain cards charge above 30%. For a retiree maintaining a balance of $8,000, which approximates the national average for individuals over 60, annual interest charges total roughly $2,200. That equals $183 monthly. This amount does not decrease your principal balance by even 1 penny. It simply transfers to the financial institution. A 10% ceiling would reduce your yearly interest expense to $800. That represents $1,400 remaining in your possession. Therefore, why am I characterizing this as potentially harmful? Because what appears to be consumer relief represents a termination sentence for your account. This is the element that no television commentator is clarifying. Credit card corporations are not charitable organizations. They are not government-operated services. They are privately owned enterprises that operate to generate profits. They generate revenue through 2 fundamental methods. The first method involves charging interest on balances that consumers maintain from 1 month to the next. Approximately 60% of all credit card account holders in America maintain a balance. For retirees over 62, that percentage is 43%. The second method operates through interchange charges, alternatively termed swipe fees, which merchants pay every time you utilize your card. Between these 2 income sources, credit card corporations produce hundreds of billions of dollars annually. Interest revenue constitutes the larger portion and specifically enables banks to counterbalance the uncertainty of extending credit to individuals who may fail to repay it. This is how that uncertainty calculation functions, and this represents the foundation for comprehending everything that follows. When you submit a credit card application, the financial institution examines your credit rating and determines your uncertainty profile. If your rating reaches 780 or higher, the industry designates you a prime borrowing candidate. The financial institution understands based on historical information spanning decades that individuals with your credit characteristics fail to repay at approximately 2 to 3%. That rate is very minimal. the financial institution can assess you 15 or 18% interest and still generate comfortable profits because very few individuals in your uncertainty category fail to make payments. However, if your credit rating is 620, you fall into an entirely different classification. Individuals with ratings in that range fail to repay at rates between 8 to 15%, depending on prevailing economic circumstances. The financial institution must assess you 25 or 30% interest to compensate for those anticipated losses while still generating revenue. That is not excessive profiteering. That represents the mathematical foundation of uncertainty-based lending. Now, here is how the rate ceiling affects that mathematics. If you establish an interest ceiling at 10% and the anticipated default percentage for a borrowing candidate is 12%, the financial institution experiences losses on every single dollar it extends to that individual. Not potentially, certainly. The financial institution cannot assess sufficient interest to compensate for the losses it anticipates. Therefore, the financial institution has precisely one logical response. It terminates the account. This is not individual, this is not partisan, this is basic arithmetic that a middle school student could perform on paper. The Electronic Payments Coalition, representing Visa, MasterCard, JP Morgan, Chase, Bank of America, and virtually every significant financial corporation in the nation, released a comprehensive examination in a recent period. Their determination was expressed clearly. A 10% ceiling on interest rates would produce account terminations or credit line decreases for nearly 90% of existing credit card account holders. 90%. That approximates 175 million Americans. The American Bankers Association published their own separate examination and reached a comparable figure. They determined that between 74 and 85% of all active credit card accounts nationwide would be terminated or experience their credit lines substantially decreased. Their calculation is that between 137 million and 159 million cardholders would forfeit access to their existing credit. Whether you reference the higher figure or the lower figure, we are discussing the most significant involuntary decrease in consumer credit accessibility in American financial history. Now, I need you to comprehend who experiences impact first, because this does not influence everyone identically. If your credit rating exceeds 740, you are probably secure. Financial institutions can still generate profits from extending credit to you at 10% because your default uncertainty is sufficiently minimal to make the mathematics viable. You may observe your credit limit decreased, and you will almost definitely forfeit some benefits, but your account will likely continue. If your credit rating falls between 670 and 740, your account faces substantial uncertainty. The financial institution will evaluate the figures on your particular uncertainty profile and render a commercial determination about whether they can afford to maintain you. Numerous accounts in this range will be terminated. Some will continue with substantially decreased limits. It depends on the financial institution and your particular history. If your credit rating falls below 670, I must be straightforward with you. Your account will almost definitely be terminated. The mathematics simply does not function at 10% interest for borrowing candidates in this uncertainty classification. There is no scenario where the financial institution voluntarily experiences losses to maintain your account active. Consider who falls into these classifications. Retirees on fixed retirement income who maintain small balances to manage prescription medication expenses or utility charges between Social Security distributions. The typical American over 65 maintains approximately $5,000 in credit card obligations. For numerous individuals, that balance does not originate from irresponsible purchasing. It originates from choosing between obtaining a prescription and covering the electricity charge, and utilizing a credit card to manage whichever one they could not afford that particular month. Individuals who experienced a medical crisis and transferred hospital charges to a credit card because they possessed no alternative choice. The typical expense of a 3-day hospital admission in America exceeds $30,000. Even with medical coverage, the portion paid directly can be overwhelming. Young adults beginning to establish credit who possess limited files and minimal ratings, not because they are careless, but because they simply have not possessed sufficient time to develop a history. Military households managing finances throughout deployments where communication interruptions and logistical difficulties sometimes produce late payments that harm credit ratings. These are not careless individuals. These are individuals utilizing credit precisely how the framework was constructed. However, this is where I must explain the cascading consequence because forfeiting the card represents only the initial portion of the harm. When a credit card account is terminated, whether you terminate it or the financial institution terminates it, your total accessible credit decreases immediately, but your existing balances on alternative cards remain precisely identical. That modifies a figure termed your credit utilization percentage. This represents one of the most critical figures in your complete financial existence. Credit utilization represents roughly 30% of your credit rating under the FICO framework. It is determined by dividing your total credit card balances by your total accessible credit limits. Let me provide you an actual illustration. Suppose you possess 3 credit cards. Card A possesses a $10,000 limit and a $3,000 balance. Card B possesses a $12,000 limit and a $4,000 balance. Card C possesses an $8,000 limit and a $2,000 balance. Your total limit equals $30,000. Your total balance equals $9,000. Your utilization equals 30%, which stands precisely at the suggested maximum. Now, Card C becomes deactivated by the financial institution because of the rate ceiling. Your limit decreases to $22,000. Your balance remains at $9,000. Your utilization just increased to 41%. That 11-point elevation in utilization can decrease your credit rating by 30 to 50 points almost immediately. And here is the unfortunate element. When your credit rating decreases, the interest rates on your remaining cards can increase. Your automobile insurance premium can escalate because numerous insurers incorporate credit ratings in their pricing. Your capacity to lease an apartment can be influenced because property managers examine credit. Your capacity to restructure your mortgage, which could preserve you hundreds monthly, becomes more difficult or unattainable. One account termination initiates a sequence reaction that extends into areas of your financial existence you never anticipated. And for retirees specifically, there exists an additional dimension of harm that almost nobody discusses. Numerous retirees utilize credit cards as their fundamental emergency reserve. They do not possess $10,000 available in a savings account. They possess a credit card with a $10,000 limit that they can utilize if the heating system fails, or the automobile requires a repair, or a medical charge arrives unexpectedly. Remove that card, and you have not simply eliminated a payment instrument, you have eliminated their complete financial protection system. The alternatives include payday lenders assessing 300 to 400% yearly interest rates, vehicle title advances that endanger their automobile, or simply proceeding without the medical attention or property repair they require. That represents the genuine human expense of this approach that nobody in the Capitol seems to be calculating. Now, I must inform you about the companion legislation because it makes everything I just described even more problematic. The credit card competition proposal was reintroduced in a recent period with support from both major political parties, from multiple senators and representatives, with a corresponding version in the House from additional representatives. There has been presidential endorsement for this one as well. Social media posts have characterized swipe fees as problematic. And here is the reality. The assessment about the fees is accurate. The typical American household contributes nearly $1,200 yearly in swipe fees that are incorporated in the price of everything you purchase. Every time you purchase groceries, fuel, clothing, a meal at a dining establishment, the merchant is contributing to Visa or MasterCard between 1.5% and 3.5% of the transaction. Merchants do not absorb that expense. They incorporate it into their pricing. Therefore, you are contributing swipe fees, whether you utilize a credit card, a debit card, or physical currency, $2,200 yearly from every household in America. The financial services sector collects over $111 billion yearly from these charges. The credit competition proposal would require financial institutions with over 100 billion in holdings to permit their credit cards to be handled over at minimum two competing payment systems instead of exclusively Visa or MasterCard. The concept is straightforward. Competition reduces charges. Merchants select the less expensive system. Charges decrease. Pricing decreases. Everyone benefits. That represents the premise, and it makes economic logic conceptually. However, the financial institutions have been very explicit about what they will implement in reaction. They will eliminate your rewards, your cash return, your travel benefits, your airline distance benefits, your transaction safeguards, your extended guarantees. All of those benefits are supported fundamentally through the interchange charges that financial institutions collect on every transaction. If those charges get reduced through forced competition, the income that supports your rewards vanishes, and financial institutions are not going to substitute that income from their own earnings. They are going to terminate the benefits. For numerous retirees, cash return rewards are not a luxury item. They represent a significant component of their monthly financial plan. 2% return on groceries, 3% on fuel, 1% on everything additional. Throughout the duration of a year, that can total $300, $400, $500 in actual savings. Remove that, and you have effectively provided retirees a compensation reduction on top of everything additional. Now, consider what occurs if both of these proposals become law in the same legislative period, which is completely feasible given that both have presidential backing and support from both major political parties. The rate ceiling terminates your account if your credit rating falls below 740. The competition proposal eliminates your rewards, even if your account remains active. You either forfeit the card completely or you maintain a card that no longer provides you any advantage for utilizing it. And in both situations, the individuals who are least prepared to absorb the consequences, individuals on fixed retirement income, individuals with restricted savings, individuals who are already financially extended, are the ones who experience the burden. Let me be very explicit about my perspective. I am not informing you these proposals are fundamentally flawed approaches. Establishing ceilings on exploitative interest rates that confine individuals in cycles of obligation is a legitimate and significant approach objective. Establishing competition in a payment handling sector controlled by two corporations is economically valid. These are genuine problems that merit genuine solutions. However, the manner these proposals are constructed currently, the outcomes will fall disproportionately on the individuals they are intended to assist. That is not a perspective. That is what the sector's own information demonstrates. And waiting until the proposals become law to determine how to safeguard yourself is an error you cannot afford to commit. Therefore, here are 5 concrete actions you should implement immediately, regardless of what Congress implements. Step 1. Examine your credit rating today, not next week. Today. You can accomplish this without charge at the federally authorized website for free credit reports. You can also examine through your financial institution's mobile application or website. Most significant financial institutions now display your FICO rating without charge. What you are seeking is straightforward. If you are above 740, you possess a cushion, but you should still prepare. If you are between 670 and 740, you are in the uncertainty zone and must take action immediately. If you are below 670, assume your accounts will be influenced and begin preparing alternative accessibility to credit immediately. Step 2. Reduce your credit card balances as aggressively as you possibly can. Every dollar you reduce decreases your utilization percentage, which safeguards your credit rating and makes your accounts less probable to be targeted for termination. Here is the approach that matters most. Do not concentrate on reducing the card with the highest total balance. Concentrate on the card with the highest utilization percentage. A card that is 80% utilized is causing far more harm to your credit rating than a card that is 30% utilized. Even if the 30% card possesses a larger dollar balance, bring your highest utilized cards below 30% first, then work on reducing everything below 10%. Individuals with utilization under 10% possess average credit ratings above 800. Step 3. Do not terminate any credit card accounts voluntarily. I must be very particular about this because numerous financial consultants instruct individuals to terminate cards they are not utilizing. Under normal circumstances, that can sometimes make logic. Currently, it represents the most harmful thing you can implement. Every active credit card account, even one you never utilize, contributes to your total accessible credit. That accessible credit maintains your utilization percentage minimal. If you voluntarily terminate a card with a $10,000 limit, you just eliminate $10,000 from your accessible credit and elevate your utilization. Instead of terminating unused cards, utilize each one for a small transaction once every 3 to 4 months and eliminate it immediately. That maintains the account active, prevents the financial institution from terminating it for inactivity, and preserves your credit line. Step 4. Develop an emergency reserve that does not depend on credit cards. I comprehend that this is more easily stated than accomplished, especially on a fixed retirement income, but even small amounts matter. Begin with $25 monthly in a separate high-yield savings account. Online financial institutions are currently contributing between 4 and 4.5% yearly interest on savings accounts. That is not going to make you prosperous, but it establishes a small cushion that belongs to you and cannot be removed by a financial institution's commercial determination. Throughout 6 months, that equals $150. Throughout a year, $300. That may be sufficient to manage an automobile repair or an unexpected medical contribution without requiring to reach for a credit card that may not be available anymore. Step 5. Establish a connection with a credit union immediately before you require one. Credit unions are fundamentally different from financial institutions. They are member-controlled, not shareholder-controlled. They are not publicly exchanged. They do not face the identical quarterly profit pressures that motivate financial institutions to terminate accounts at the first indication of uncertainty. Numerous credit unions provide credit cards with interest rates that are already substantially below the national average. They provide more adaptable lending standards. They frequently possess lower charges and superior customer assistance. If your account at a major financial institution becomes terminated, possessing an existing connection with a credit union provides you somewhere to turn. However, credit unions also possess membership prerequisites and application procedures. Do not wait until you are desperate. Establish a basic savings account with a local credit union this month that establishes your membership and establishes a connection you can develop later. And I must provide you one final caution. Watch for the fraudulent schemes. I state this in every presentation because it is that critical. Every single time there exists a significant financial approach modification or news development that influences millions of individuals, the fraudsters activate within days. You will obtain emails that appear like they originate from your credit card corporation, informing you your account is about to be deactivated and you must select a link to confirm your details. That represents a phishing scheme constructed to steal your login information. You will receive phone communications from individuals claiming to represent Visa or MasterCard, requesting you to verify your card number and expiration information. That represents identity theft. You will observe advertisements on social platforms for corporations that guarantee to safeguard your credit rating or preserve your accounts for an advance charge of $200 or $500. Those represent fraudulent schemes. Your actual credit card corporation will contact you through authorized channels, through the application, through your online account, through United States Postal Service correspondence. They will not call you demanding immediate action. They will not text you with a link to select. They will not establish artificial urgency. The number one indication that you are being contacted by a fraudster is the sensation of panic. If someone is making you sense like you must act immediately this second, stop, disconnect, delete the message. Contact your financial institution directly through the number on the reverse of your card. Here is the fundamental conclusion. Two pieces of legislation with broad political backing are advancing through Congress simultaneously. One would establish interest ceilings in a manner that makes it mathematically unviable for financial institutions to preserve most credit card accounts. The other would reduce the income that supports every reward benefit you depend on. Neither has become law yet. However, the fact that both have presidential endorsement and support from both major political parties indicates which direction this is proceeding. The time to prepare is not after these proposals become law. It is immediately. Examine your credit rating today. Begin reducing your highest utilized cards. Maintain every account active. Develop savings outside of credit. Establish a credit union connection. These are not dramatic measures. They are common logic financial actions that safeguard you regardless of what Congress implements. If the proposals become law, you are prepared. If they do not become law, you are in a stronger financial position regardless. There is absolutely no disadvantage to preparing. If this was valuable, distribute it with someone who maintains a credit card balance. That represents more than half of America currently. Total credit card obligations in this nation just reached $1.28 trillion. That represents the highest figure ever documented. The individuals maintaining that obligation are the ones most vulnerable from what is approaching. Subscribe because these updates continue coming and every one of them could influence your financial situation. Submit your questions in the comments. Your question may become the following presentation.